Welcome to our deep dive into a critical economic phenomenon, interest rate disconnection. We're exploring the current economic landscape, where traditional interest rate expectations are being challenged by market realities. Historically, there's been a clear convention. Central bank policy rates and broader market rates move in tandem. For decades, macroeconomic thinking has assumed that changes in central bank policy rates transmit smoothly across the financial system. Policy rates anchor short-term funding costs and, through expectations and arbitrage, influence bond yields, mortgage rates, and consumer and corporate borrowing costs. In both theory and practice, rate cuts have historically lowered borrowing costs and stimulated growth, while hikes have tightened financial conditions. This perceived linkage has shaped policymaking, fiscal planning, and borrowing decisions, making the idea that rates follow rates a deeply ingrained convention, one that makes any breakdown in this relationship appear anomalous rather than structural. Because this rate linkage has held for so long, it has strongly shaped how economists and policymakers think about economic slowdowns. When growth weakens, the default response is to call for rate cuts, assuming lower policy rates will automatically ease borrowing costs across the economy. This mindset is evident in current political pressure, with Donald Trump urging the Federal Reserve to cut rates more aggressively on the belief that doing so would lower mortgage costs, reduce household debt burdens, and support asset prices. Underlying this argument is the assumption that the Fed still exerts tight control over economy-wide borrowing costs and that high rates simply reflect insufficient easing. Central banks themselves have reinforced this belief through tools like forward guidance and balance sheet policies designed to transmit policy intent to markets. Yet this raises a critical question. What if financial conditions are no longer as responsive to policy rates as they once were? But what happens when this connection breaks? We enter the realm of interest rate disconnection. We are increasingly seeing a clear disconnection between policy rates and market rates across advanced economies. In the United States, mortgage rates remain elevated even as the Federal Reserve has begun easing, reflecting structural housing shortages, higher term premia, and investor caution rather than movements in the Fed funds rate. Bond markets show a similar pattern. Long-term yields are rising or staying high despite stable or lower policy rates, driven by fiscal risks, heavy debt issuance, and inflation uncertainty, meaning long-end rates are now pricing government finances more than central bank policy. Credit card rates underscore the disconnect most clearly, remaining near record highs as lenders focus on default risk, borrower quality, and capital constraints rather than lower funding costs. Together, these trends indicate that borrowing costs are increasingly shaped by risk, structure, and supply-demand dynamics, with policy rates playing a diminished and more indirect role, especially in the post-pandemic environment. Policymakers have responded with a broad mix of measures to bring borrowing costs down, including policy rate cuts, slower quantitative tightening, housing subsidies, mortgage guarantees, and regulatory pressure on banks to sustain lending. However, these efforts have had limited impact. Mortgage rates remain high due to supply constraints and elevated long-term funding costs. Bond yields stay volatile amid worsening fiscal dynamics, and consumer credit remains expensive as lenders prioritize risk over cheaper funding. This outcome underscores a key reality. Tools designed for a world where rates move together are less effective in today's disconnected environment. Central banks can steer short-term rates but struggle to control term premia without damaging credibility, while government interventions risk distorting credit supply rather than sustainably lowering borrowing costs. Looking ahead, the outlook is uncertain. Will this disconnection persist, or will traditional trends reassert themselves? This raises the question of whether rates will eventually reconnect, or whether the current dislocation will persist. While history suggests that such gaps can close as inflation stabilizes, fiscal positions improve, and risk appetite returns, allowing traditional monetary transmission to reassert itself. The case for a lasting shift appears stronger. Structural forces such as higher public debt, more volatile inflation, aging populations, and fragmented global trade are pushing risk premia higher and making markets more responsive to fundamentals than to policy signals. As a result, long-term yields, mortgage rates, and consumer credit are likely to remain partially decoupled from central bank actions. Rather than a full reconnection, a new equilibrium is emerging in which policy rates influence short-term conditions, while longer-term and consumer-facing rates are increasingly shaped by fiscal credibility, supply constraints, and risk perceptions. In conclusion, the current rate disconnection calls for a fundamental rethink of how we interpret interest rates in today's macro environment. This is not a temporary anomaly, but a sign that the financial system has structurally changed, weakening the assumption that rate cuts automatically lower borrowing costs across the economy. Markets are signaling that risk, structure, and credibility now matter as much as policy rates themselves. For policymakers, this requires more realistic expectations and closer coordination with fiscal policy. For investors, greater focus on term premia, credit risk, and supply dynamics. And for households, a clearer understanding of why borrowing costs remain high despite rate cuts. What we are seeing is not the failure of monetary policy, but its evolution. And grasping that shift is crucial to navigating the next phase of the global macro cycle. Thank you for joining this economic discussion. Stay informed on these crucial developments.